He had 8 properties, $4 million in real estate, and on a Tuesday morning, holding a coffee he could suddenly no longer afford, he watched every single one of them disappear in under 48 hours. Not because he missed a payment, not because the market crashed, not because interest rates moved against him. Because of 4 words buried on page 31 of a contract he signed without reading in a lawyer's office, and on an afternoon when he was too excited about his expanding portfolio to slow down and understand what he was actually agreeing to. Stay with me, because what happened to David Chen, 39, a former logistics manager from Mississauga, is not an isolated story. It is not a cautionary tale invented to fill airtime. It is a precise, repeating mechanism that the major lending institutions in this country have been quietly engineering for the past 18 months. And the scale of what is currently being executed across the Canadian real estate market is something that most financial media is either unwilling or structurally unable to cover with the clinical precision it demands. Over the next 14 minutes, we are going to walk through the exact anatomy of a portfolio collapse, not the emotional version, the mechanical one, the version the banks understand completely and most investors fundamentally do not. We are going to follow David's situation from the morning the algorithm first flagged his account to the moment the deficiency judgment was registered against his name. And we are going to show you exactly how the damage radiates outward from one borrower's decisions into the equity of every innocent family living on the same street. This is Canada Property Watch. David's story begins the way most of these stories begin, not with desperation, with confidence. Between 2019 and 2023, he used a strategy he learned from a combination of paid weekend seminars, social media educators with large followings and larger claims, and a network of independent mortgage brokers operating in the gray space between legitimate lending and outright contract violation. The strategy is straightforward in concept. Buy a residential property, renovate it to increase its appraised value, place a tenant generating monthly income, and then refinance against the inflated appraisal to extract capital and fund the next acquisition. Repeat the cycle indefinitely and watch the portfolio compound. The community that promotes this approach calls it BRRR. The banks have a different name for what it produces when applied at scale without verified, stable income documentation. They call it a synthetic asset cluster. And for the past 3 years, they have been quietly constructing the analytical infrastructure required to dismantle every single one they can identify. By early 2024, David held legal title to 8 single-family homes across 3 suburban municipalities in the Greater Toronto Area. His total mortgage exposure across those 8 properties was approximately $6 million. His monthly payment obligations exceeded $22,000. On paper, the rental income from those 8 properties was documented at $31,000 per month. That documentation was the foundation of everything David had built. And it was, in at least 4 of those 8 cases, a number that bore no meaningful relationship to the cash actually moving through those properties. Here is the specific mechanism David used, and here is precisely why it worked for as long as it did. When a borrower applies for a mortgage on an investment property in Canada, and the lending institution uses a calculation called the gross debt service ratio to determine whether the borrower's total income is sufficient to carry the new obligation alongside their existing financial commitments. For a standard salaried employee earning an average professional income, the ceiling on this calculation is reached very quickly. One investment property, perhaps 2, is often the absolute mathematical limit given typical employment income. To acquire property, 3, 4, 5, and beyond, the borrower must demonstrate that each new property generates enough independent rental revenue to effectively service its own mortgage without depending on the borrower's personal employment income to fill the gap. The bank requires a lease agreement as primary evidence of that revenue. A signed document, a tenant's legal name, a monthly dollar figure, a security deposit confirmation. During the peak application volumes of 2021 and 2022, But when the Canadian real estate market was operating at transaction velocities that created structural pressure across entire institutional underwriting departments, a significant number of applications were processed at a pace that made individual document verification forensically incomplete. Lease agreements were reviewed for format compliance and basic numerical coherence, and the name of a tenant on a page was accepted as reasonable confirmation of a living individual occupying a physical address and generating verifiable monthly income. The volume made deeper scrutiny operationally impractical, and the risk models of that period were not calibrated for a rising interest rate environment with deteriorating borrower cash flow profiles. David's broker understood exactly how that system operated. He had processed hundreds of applications through the same framework, and in the same window with the same structural shortcuts. The lease document David submitted looked entirely legitimate to a time-pressured underwriter. The monthly figures on the document were calibrated with precision to clear the specific underwriting threshold the software required. And in 4 separate instances across David's expanding portfolio, the individuals named as tenants on those lease agreements had no utility registrations at those addresses, no mail forwarded to those locations, and no transaction history linking them to those properties in any verifiable form, and in 2 cases no awareness that their names were being used on legal documents at all. This is not speculation. These are the specific findings documented in the forensic audit that David's primary lender initiated and completed in the 3rd quarter of 2024. Now here is the number that should make you stop completely and reconsider what you think you know about how these investigations begin. The bank's internal compliance division did not discover David's situation through a whistleblower complaint. They did not receive a tip from a competitor institution. And they did not schedule a routine audit of his file as part of a calendar review. The algorithm flagged his account automatically after detecting a deviation pattern across 17 consecutive months of transaction data. Specifically, the monitoring system identified that David's primary operating account showed 0 recurring deposits in the amount or approximate range documented across 4 of his 8 lease agreements. The software cross-referenced the expected monthly inflows against actual account activity and identified a structural cash shortfall averaging $14,000 per month that was being covered through a continuous rotation of unsecured credit draws, personal line of credit advances, and internal fund transfers between multiple accounts David directly controlled. That pattern has a formal name inside institutional risk management. It is called a cash flow substitution loop, and the monitoring software deployed across major Canadian lending institutions is now specifically and deliberately calibrated to detect it at the account level across their entire commercial client base. Not because the banks are selectively pursuing specific borrowers, because the cash flow substitution loop is a statistically reliable indicator validated across thousands of case files, and that the revenue documentation underlying a loan is failing to reflect the operational reality of the underlying asset. Once the algorithm generates a flag with sufficient confidence, the file moves silently to a human forensic investigator within the bank's corporate security division. That investigator does not contact the borrower. They do not send a preliminary information request. They work backward through the original documentation completely silently, cross-referencing every name, an address, and figure on every lease agreement against open registry data, utility activation records, Canada Post forwarding databases, and National Credit Bureau histories. In David's specific case, the full investigation required 11 business days from the initial algorithmic flag to the completion of the forensic report. At the conclusion of those 11 days, the investigator had formally documented and evidenced that 4 of David's 8 investment properties were carrying active mortgage obligations supported by income representations that did not reflect verifiable ongoing tenancy arrangements. The bank's legal department was formally notified. The demand letter for the 4th property was prepared. David received it on a Tuesday morning. He read it twice. His immediate instinct, which is the same instinct virtually every investor in this specific situation reports experiencing, was one of containment. Isolate the problem. Sell property. 4. Absorb the financial loss on that single asset. use the proceeds to retire that specific mortgage, and protect the remaining 7 properties, which were, in David's view, entirely separate and entirely safe. That instinct was not just wrong. It was the single most expensive misunderstanding of his financial life, what David had never genuinely engaged with, and what the overwhelming majority of multi-property investors actively avoid engaging with because the contractual reality is deeply uncomfortable, is the legal architecture that governs how a major Canadian lending institution structures its total exposure to a single, high-volume borrower. When one individual finances multiple properties through the same institution, and the bank does not treat those individual mortgages as 8 independent, isolated contracts with no relationship to one another. The master borrowing agreement that governs a multi-property portfolio at a major Canadian lender contains 2 specific provisions that function together as a single, unified structural kill switch. Most borrowers sign this agreement without reading it. Their brokers do not explain it to them because explaining it would make the transaction more difficult to close. The first provision is cross-collateralization. This clause legally designates the equity position in every single property the borrower holds with the institution as collective, unified security for the entire consolidated debt load. The bank's exposure to David is not 8 separate and independent $600,000 risks that can be managed individually. It is a single $6 million risk exposure backed by 8 physical assets that function as a combined collateral base. Remove one and the security structure of every other loan is materially affected. The second provision is the mechanism that converted David's manageable single property problem into a total portfolio execution in under 2 business days. The cross-default clause. The language in these agreements is direct and unambiguous. That if the borrower is found to be in material breach or default on any single credit facility held with the institution, that breach automatically and simultaneously constitutes a default event on every other loan, mortgage, line of credit, and credit facility the borrower holds with that same institution. Not after a negotiation period, not after a formal review process, not after a missed payment on the other accounts, automatically, immediately. And as a matter of binding contractual law, at the moment, the primary default is formally registered in the institution's systems. David received the demand letter for Property 4 on a Tuesday morning. By Thursday morning of the same week, 7 additional registered envelopes arrived at his primary residence via courier. Each one contained a formal mortgage acceleration notice for one of his remaining 7 properties. The bank was no longer requesting repayment of $800,000 on a single defaulted asset. They were executing the cross-default protocol across the entire portfolio and demanding the immediate, unconditional repayment of the full $6 million consolidated balance within 15 calendar days. There is no appeal mechanism for a cross-default execution that is supported by documented forensic evidence of material misrepresentation at loan origination. And David's legal counsel reviewed the complete file and delivered a single paragraph assessment. There was no viable legal defense. Now step back from David entirely for a moment because this is the point in the story where the damage leaves one address and begins spreading across an entire community of people who never made a single questionable financial decision in their lives. When a major lending institution executes court-ordered possession across an entire multi-property portfolio, they do not manage the resulting liquidation with patience or sensitivity to local market conditions. They assign the seized assets to a specialized corporate recovery firm operating under a mandate for rapid capital recovery. In David's case, all 8 properties were formally listed on the multiple listing service within a compressed 2-week window. 4 of those properties were located within a 2-kilometer radius of each other in the same established suburban subdivision. The recovery firm priced every single property at a discount calibrated to guarantee fast, unconditional transactions. The discount ranged between 22 and 28% below recent comparable sales in the immediate surrounding area. The pricing logic is straightforward and entirely unsentimental. Every additional month a seized property sits unsold represents ongoing carrying costs, mounting legal administration fees, and continued exposure to further market depreciation. Velocity of liquidation is the only variable that matters to the recovery firm. The price is simply the tool used to guarantee that velocity. For the families on those streets who had no connection to David, no knowledge of his portfolio structure, and no exposure whatsoever to his decisions, the impact arrived without warning and without recourse. When a comparable property on your specific street sells at a documented 26% discount, and that transaction is immediately recorded as a legal comparable in the municipal and provincial appraisal databases. Every subsequent property valuation in that immediate area is recalibrated against that new reference point. The equity you have been steadily building through 5 years of consistent, legitimate mortgage payments does not disappear because of any decision you made. It disappears because the financial construction of an investor you never met collapsed across the street from you and was liquidated by an institution that had no interest in protecting your neighborhood's pricing stability. This is the collateral consequence that the culture of leveraged amateur real estate speculation never accounts for in its advertised return calculations. The personal upside is promoted loudly. The neighborhood externality is never mentioned. Now back to David. Because the personal financial conclusion of this specific story is the dimension that most commentary in this space declines to cover with the full precision it deserves. The rapid liquidation of David's 8 properties generated approximately $4,700,000 in total recovery proceeds for the institution, against a $6 million principal obligation. That left a deficiency of approximately $1.3 million unrecovered after all transaction costs and legal fees were settled. In a standard foreclosure scenario involving legitimate financial hardship and a borrower who made accurate representations at origination, the lending institution would file a formal claim with the applicable mortgage default insurer to recover that shortfall. The insurance mechanism exists precisely to protect institutional capital in the event of genuine borrower default caused by changed financial circumstances. That mechanism does not activate when the originating loan was structured using materially inaccurate documentation. The default insurer conducted its own independent review of David's file, identified the specific misrepresentations embedded in the original lease agreements, and denied the bank's claim in its entirety. In citing deliberate and documented material misrepresentation by the borrower at origination as a fundamental violation of the insurance policy terms, the bank absorbed the full unrecovered loss directly and filed a civil deficiency judgment against David personally for the complete outstanding balance, plus accumulated legal costs and administrative penalties, when the total registered judgment exceeded $1.5 million. A deficiency judgment of that magnitude does not expire on a fixed timeline. It attaches to David's future employment income through a court-authorized wage garnishment order. It intercepts future income tax refunds through government offset mechanisms. And it registers as a permanent lien against any future asset David attempts to acquire, including any future real property, for the duration of its enforcement. The financial structure David spent 5 years constructing to generate what he described to friends as generational wealth has been legally replaced by a parallel structure designed to extract capital from his future earnings for the remainder of his working life. The portfolio is gone. The properties are gone. The credit profile is permanently marked at every major institution, and the monthly financial obligation has not ended. And it has simply been transformed from a mortgage into a judgment. The banks are not finished running this sequence. The algorithmic audit infrastructure that identified David's account is now operating at full institutional scale across the loan books of every major Canadian lending institution simultaneously. The monitoring is not targeted at specific individuals or specific municipalities. It is scanning continuously for the pattern, the cash flow substitution loop. The persistent deviation between income documentation submitted at origination and verified cash flow activity in current account records. Wherever that pattern appears with sufficient consistency across a multi-property borrower profile, the file advances automatically to human forensic review, and the legal escalation protocols are already loaded and waiting. If you are currently holding a leveraged real estate portfolio financed through institutional lending in this country, There is one question that overrides every other consideration in your financial life right now. Does the income documentation you submitted at origination accurately reflect the cash flows that are verifiably moving through your accounts today? Not what you intended at the time. Not what your broker advised you was standard industry practice. Not what the seminar presenter described as a universally accepted approach to qualifying for leverage. And what the data in your accounts actually shows when it is placed beside the documents you signed, because the institution holding your mortgages is asking exactly that question about your file. Quietly, continuously, right now. The era of passive institutional trust in investor-submitted documentation is over. What has replaced it is systematic, continuous, a data-driven verification with legal escalation architecture that is already fully operational and actively executing. You are watching Canada Property Watch. The next investigation moves into territory that most financial channels will not go near. We have documented evidence that a growing number of tenants currently occupying investment properties across the country have identified anonymous federal financial tip lines as a strategic tool, not to report genuine wrongdoing out of civic concern, but as a deliberate, calculated mechanism to initiate banking audits against their landlords, specifically to prevent eviction proceedings before they begin. The tenant currently living below you may already be the most consequential variable in your financial exposure profile. That investigation is next. Subscribe now and enable notifications. Because in this market, the people who understand what is already moving are the only ones with enough time to respond.